50 days left. Save yourself and get rich before the economic crisis. You have 50 days left to save yourself and build wealth. When a U.S. government tells you the economy might be heading into a recession, when the Federal Reserve says the downturn is due to tariffs, when stock market oracle Warren Buffett warns that tariffs will cause the U.S. dollar to lose value, when the titans at Bridgewater claim the monetary system is collapsing, when a global bond mogul predicts a massive sell-off of U.S. bonds, when George Soros' hedge fund group says the U.S. is being shorted, when all these figures, each capable of shaking the world with a snap of their fingers, collectively tell you that America is racing toward collapse, and indeed, U.S. stocks, bonds, and the dollar are all plummeting simultaneously, is the U.S. really on the brink of collapse this time? In the coming month, we must always be prepared for the worst-case scenario. The U.S. collapses, goes bankrupt, and its stocks, bonds, and dollar turn into worthless paper. Will this really happen? Think Billionaires channel welcomes you all. The last time we heard these warnings most prominently was during the 2008 financial crisis. Back then, even U.S. banks went bankrupt, the stock market crashed, housing prices plummeted, and countless people's assets evaporated. But here's the question. Has the U.S. collapsed yet? Has it gone bankrupt? Have U.S. stocks, bonds, and the dollar turned into worthless paper? Why is the U.S. dollar the global reserve currency? You'll notice that the assets in any country's treasury around the world mainly come in two forms: gold and foreign exchange reserves. In other words, when a country earns money, it either uses that money to buy gold or to purchase foreign currency for reserves, storing it in its national treasury. Why is that? Think about it. If Japan wants to buy oil from the Middle East today, if Germany wants to purchase high-end chips from Taiwan, or if Brazil wants to pay off its debts, would I accept payment in yen, euros, or reals, currencies printed by your country? No, I'd only accept two things: gold or U.S. dollars. If you want to do business with me, or even pay off your debt to me, I'll only take gold or U.S. dollars. That's why over 80% of global trade transactions must be settled in U.S. dollars. Without dollars, you can't even buy oil or food. For example, a South Asian country, due to a lack of dollars in 2023, couldn't purchase oil, causing domestic gas prices to skyrocket. Or take 1997, during the Asian financial crisis, when the currencies of several Southeast Asian countries lost value drastically because the world rushed to sell them off. Simply put, the world no longer believed those currencies could buy goods, thinking they were about to become worthless. In such a scenario, if those countries held U.S. dollars, they could use them to buy back their own currency, stabilizing exchange rates and preventing a financial collapse. That's why countries like China, Hong Kong, Taiwan, Singapore, Saudi Arabia, or Japan either stockpile gold or U.S. dollars. The U.S. dollar is the global reserve currency. Why do countries buy U.S. Treasury bonds? But here's the thing. The world has accumulated nearly $10 trillion in U.S. dollars as foreign exchange reserves. Yet, they don't lock these dollars in a vault. Instead, they're frantically buying U.S. Treasury bonds. Why? It's simple. Most people know the Federal Reserve can print money. Today, Americans bring heaps of dollars to Japan, buying up products painstakingly made by the Japanese, leaving behind only the dollars they printed. Of course, Japan can use those dollars to buy goods worldwide. But if the Fed keeps printing money without limits every year, the dollar's value will erode. For instance, over the past 20 years, the dollar's purchasing power has dropped by 40%. That means if I do nothing and just hold dollars, my ability to buy goods has decreased by 40%. Since cash doesn't generate interest, if I don't use that money to buy U.S. Treasury bonds, it's as if my wealth is being silently stolen. Take China as an example. It's said that China earns billions of dollars from the US each year. When that money flows into China, if China doesn't channel those dollars back out, the Chinese yuan will appreciate and skyrocket uncontrollably. Here's how it works. Today, a Chinese factory earns $1 billion. Can they directly use that $1 billion domestically? No. They must convert it into yuan to use in China. In other words, when China earns billions of dollars annually, those dollars are sold to buy yuan, causing the yuan to appreciate. And when the yuan appreciates, China's exports become more expensive. Before, $100 could buy a pair of shoes. Now, it might take $150. That makes the shoes less competitive price-wise, potentially unsellable. If goods don't sell, factories close, and countless people lose jobs, leading to an economic collapse. The lesson of the Plaza Accord, Japan's 30 lost years. That's why many countries remember the lesson Japan taught the world. Back then, Japan sold countless appliances and cars to the US, earning a massive amount of dollars. So, American capitalists set up a trap specifically for Japan, forcing Japan to sign the Plaza Accord, which made the yen appreciate. The exchange rate went from $1 to 240 yen to $1 to 120 yen. In simple terms, the yen doubled in value, so the price of Japan's exports also doubled. What was the result? Brands like Toyota and Sony couldn't sell their products anymore. Factories gradually moved to China, and Japan's economy entered a 30-year period of stagnation. This means that if a country relies heavily on exports to earn money, and its currency appreciates, its products become more expensive, harder to sell, factories go bankrupt, the economy collapses. The US stops buying from that country, shifting to others like China. You should remember this principle. When a country earns a lot of dollars, if it doesn't channel those dollars back out, its domestic currency will appreciate, harming exports. That's why, after earning dollars from around the world, countries often use them to buy US Treasury bonds or gold and store them. When the time comes, they sell that gold or bonds to get dollars for spending. This is also why foreign exchange reserves don't just consist of US dollars, but are primarily US Treasury bonds. Why does the world choose US Treasury bonds? Why US Treasury bonds? For example, Brazil's central bank issues bonds that might offer a 12% interest rate, while US Treasury bonds a few years ago yielded less than 2%. That's a 10% interest rate gap, right? Yet the world still rushes to buy US bonds. Why? Because even if it looks like you're losing 10% in interest, if Brazil's currency collapses, it could lose 20% to 30% of its value. At that point, even if you earn 10% in interest, you'll still lose at least 20% to 30% due to devaluation. And that's just a loss on paper. If Brazil's currency truly collapses, and you're a country holding a large amount of Brazilian currency, you won't even be able to sell it. So if not US Treasury bonds, do you think bonds from the UK, Germany, or Japan are more stable than US bonds? That's why, despite many saying the US is about to collapse, has it gone bankrupt? Can the US really go bankrupt? In reality, the US cannot go bankrupt. For example, if Ukraine borrows trillions of dollars and can't repay, it could go bankrupt. Then Ukraine's stocks, currency, and bonds might become worthless because Ukraine can't print US dollars. But the money the US borrows is in US dollars, the same currency the world holds as reserves, nearly $10 trillion worth. And dollars are printed by the Federal Reserve each year. So how could they go bankrupt? That's why Americans openly say the US's defense spending is paid for by the world, not by themselves. Because the world lends money to the US, and the US can simply print more money to pay off its debts. That's dollar hegemony. The US rebirth plan, global crisis, American recovery. Some argue that times have changed, that the U.S. wants to rise from the ashes, triggering a global financial crisis so it can recover the fastest, pushing the world to the bottom while America rises to the top again. In simple terms, they want to blow up their own economic house to rebuild a stronger one. Many don't believe this, thinking, in the future, we won't need the dollar anymore. We can use euros or yuan instead. The U.S. won't be able to strangle the world like before. I agree that the world is discussing de-dollarization, and the dollar's dominance isn't as unchecked as it once was, plundering global wealth at will. But let me ask you this. The world has bought $10 trillion in U.S. Treasury bonds. How much foreign capital has flowed into European or Chinese bonds? If there were $10 trillion in international money ready to lend to China and Europe, if the world were willing to hold yuan and euros as reserves, then China and Europe's economies would take off immediately, and dollar hegemony would collapse entirely. The U.S.'s rebirth plan would fail completely. But right now, I don't see the world holding euros or yuan. I only see that even when they sell off U.S. bonds, they're stockpiling gold. And the country holding the most gold in the world is still the U.S. Why does the U.S. want the world to collapse? So why are financial giants, the Federal Reserve, and even the U.S. government still propping up America? Because they want the world to collapse, not the U.S. They want a financial crisis, not a Great Depression in America. They want to use financial rules to control the globe, not just rely on tariffs to make money. This is the most accessible financial plunder for ordinary people. If you just obediently go to work and do nothing else, you're essentially working for free for others. The money you earn will flow into the hands of capitalists, and right now, those stuck in old stocks will lose everything. If you don't want to be a victim in this game, or even hope to take a step forward to rise above your current class, you can follow my channel, as I'll continue sharing more insights with you. And if you're worried you'll forget after reading, wasting your time, you can like this post. That way, it will automatically save to your playlist, allowing you to revisit and act on it anytime. Tariffs, the new Plaza Accord. Many say the U.S. government's tariffs on the world have failed. They only applied them for 90 days like a short-term game. But if you understand what I've explained, this round of tariffs is actually a new version of the Plaza Accord. What's the goal? To show the world the consequences of not complying. What does that mean? Look at the U.S. dollar index. Since the start of the year, it has lost 10% of its value. Many will say it's because global capital is fleeing the U.S. Everyone's selling dollars, so the dollar is depreciating and the U.S. is suffering heavy losses. But is that really the case? I've already said, a weaker dollar is good for the U.S. Simply put, this year, they have to repay trillions in bonds. With the dollar losing value, doesn't that mean the real amount they have to repay decreases? At the same time, it triggers a global stock and bond crisis. Capitalists who sold stocks earlier and held cash, don't they now have the chance to buy back assets at fire sale prices? Meanwhile, the Federal Reserve can justifiably pump money to rescue the market. You can verify these things yourself. I won't elaborate. The global fallout of tariffs. Everyone loses. The key point is this. In this tariff war, the result we see is that, aside from a few Asian currencies losing value against the dollar, most other currencies worldwide have appreciated against it. What does this mean? If you're a Japanese merchant selling goods to the U.S. today, earning $1 million, 30% of that must go to tariffs. So you're left with $700,000. When you convert that into yen, you might have gotten 10 million yen before. But if the yen is appreciating, you'll now only get 8 million yen. In other words, when you, a Japanese merchant, do business with me, an American, I've already taken a chunk of your profits through tariffs. Now, with the yen appreciating, you lose another portion of your profits, don't you? In simpler terms, Tariffs combined with currency appreciation raise your cost of doing business. Ultimately, you have no choice but to sell your exports to the U.S. at a higher price. What's the core of the Plaza Accord or tariff policies? It's not just to make your currency appreciate. It's to make your goods sold to the U.S. more expensive, so no one buys them. In the end, your goods pile up domestically, your businesses go bankrupt, your people lose jobs, your economy collapses, losing 30 years of development. So, with just a few days of short-term tariffs, a U.S. leader has already said, the whole world is lining up to bow to his will. Because they all remember Japan 30 years ago. This image on the wall makes the world look at Japan back then and see themselves today. Global consequences. The world collapses, America rises. Now, the U.S. has to repay less debt to the world. Meanwhile, the goods the world sells to the U.S. become more expensive, quickly losing their market, potentially turning into the next Japan. So what can be done? You can only let your currency depreciate. There are two ways to do this. Sell your own currency. Buy foreign exchange reserves. That means buying U.S. dollars and treasury bonds. That's why we see U.S. bonds no longer falling in price, even showing slight recovery. Because countries worldwide don't want their currencies to keep appreciating, they're forced to buy U.S. bonds. This is the U.S.'s hostage strategy. If you don't buy U.S. bonds, fine. At best, you'll face what's happening now: tariffs, currency appreciation, unsellable goods, and economic recession. At worst, your economy will collapse entirely. The lesson from Russia: when reserves are frozen. The last time we saw a major power's currency plummet was when Russian troops entered Ukraine. At that time, Russia's currency lost 30% of its value in just 1 week. Why? Because the U.S. froze $300 billion of Russia's foreign exchange reserves, locking its assets. Russia suddenly had no dollars to trade with the world. I have a friend who used to run a civil aviation business in Russia. He was the first billionaire I met while in college. But now, the money he holds can't be converted into dollars. On the surface, the Russian currency has lost half its value against the dollar. But in reality, on official markets, it's nearly impossible to exchange for dollars. You'd have to go to the black market. On the black market, the exchange rate of the Russian currency to the dollar has lost 2 to 3 times its value. That means his wealth has evaporated 2 to 3 times over, unable to be converted back into dollars. His money can now only be spent in Russia. Dedoyerización. Dream? Many say that times have changed. If the U.S. keeps this up, the dollar will collapse too. Let's look at reality. Despite Saudi Arabia's talk of de-dollarization, they still accept dollars for oil. China sells long-term U.S. bonds, but buys short-term ones. Not to mention Japan, the UK, and Canada. Simply put, a country's exchange rate is backed by gold and U.S. bonds. If U.S. bonds collapse, the assets your country holds will collapse too. Can your currency hold up? So when the U.S. financial system, the Federal Reserve, and even the government say America is in trouble, the dollar does lose value, but it won't collapse. On the contrary, this helps the U.S. pay less debt, lowers the price of U.S. assets, so capitalists like Buffett, holding massive cash reserves, can buy them back at rock-bottom prices. Most importantly, it forces the world to keep buying U.S. bonds. Of course, you could choose not to buy, but your economy will either end up like Japan 30 years ago, or worse like Russia today. A currency war. Who's next? So, do you think this is just a currency war between the U.S. and the world? When the Japanese, Thais, and Russians can only watch their assets evaporate without recourse, who will be next? When even governments can't guarantee the safety of people's assets, shouldn't we learn to protect ourselves? Don't rely on the state to take care of us. Many are still brainwashed, thinking that holding assets long-term will lead to recovery. I can only say, those people will wake up too late. I've met too many like that. An alternative, buy gold instead of U.S. bonds? Some might say, I won't buy U.S. bonds. I'll buy gold. It can also devalue my currency. True, but you still need U.S. dollars to buy gold, don't you? In other words, if a country uses its foreign exchange reserves, U.S. dollars and bonds, to buy gold, won't the amount of dollars and bonds they hold decrease? It sounds obvious. Since last year, when we started allocating investments into gold, how much has its price risen? It's up 68%, meaning a country now needs 68% more dollars than last year to buy the same amount of gold. Simply put, the price of gold has skyrocketed. If your country wants to buy gold, it'll cost more dollars. Plus, if you choose gold over U.S. bonds, the U.S. might slap heavy tariffs on you, making it harder to earn dollars. Then, your country will face a severe dollar shortage. If U.S. capitalists start short-selling gold, dragging its price from peak to trough, and your country, lacking dollars, can't buy to prop up the price, you won't be able to sustain gold value. Your country will watch helplessly as the gold bought at a high price keeps losing value. In other words, you'll lose not just dollars but gold too. To put it plainly, your country's assets have been indirectly transferred to the U.S. History repeats. The 2008 crisis and gold short selling. You might say this is just my speculation, but I'll tell you, history always repeats. After the 2008 financial crisis, the Federal Reserve kept pumping money. While the global economy was at its lowest, the U.S. economy not only recovered immediately, but became stronger than before. So, the world has tried de-dollarization before. They kept buying gold. From 2008 to 2011, gold prices soared by 177%. At that point, U.S. capitalists laughed and immediately issued a directive. Goldman Sachs, following orders, released the first bearish report on gold, predicting a 30% drop. Right after, Wall Street flooded the market with negative gold reports, intentionally sparking panic. This was the first step in their short-selling plan. Step 2. Wall Street aggressively sold gold worldwide, rapidly driving down its price, making the world think, wow, Wall Street was right. Gold is crashing. So the world started selling too, creating a downward trend. As long as you find 1 or 2 helpful quotes in this video that improve your life, I'm already fulfilled.